Under the surface, today's market reaction revealed something important about investor expectations. The policy bazooka may have finally met its match in the physical reality of a supply shock. It was a day characterized by a growing disconnect between policy promises and market prices. While the Dow Jones fell over 0.5% and the S&P 500 slipped, the Nasdaq managed to hold steady, virtually unchanged on the day. The most telling action, however, was in the bond and commodity markets. Despite a historic announcement to flood the market with oil reserves, crude oil actually rose over 2%. At the same time, the 10-year Treasury yield spiked nearly 2%, signaling that investors are bracing for a much more aggressive path for interest rates. The primary driver today was the market's skepticism toward the International Energy Agency's decision to release 400 million barrels of oil, the largest release in history. On paper, this should have crushed prices, but expectations shifted because investors are looking at the logistics. There is a growing doubt that these paper barrels can move fast enough to replace the 14 million physical barrels currently blocked in the Strait of Hormuz. This skepticism was deepened by a long war declaration from Iranian officials, who threatened to target regional economic centers. Suddenly, the narrative shifted from a temporary disruption to a multi-month infrastructure risk. Even a safe inflation print of 2.4% today was largely ignored. Investors are already looking through the data, treating it as a relic of a PI conflict world that no longer applies to the upcoming reality. Institutional money responded by moving into a barbell positioning. On one side, capital is flooding into the supply-side energy majors that benefit from high prices. On the other side, money is hiding in innovation, specifically high-conviction AI software like Oracle, which surged on massive backlog numbers. To fund this, institutions are abandoning bond proxies like consumer staples and real estate. These sectors are being caught in a pincer move. They lack the pricing power to fight inflation, and their yields are becoming less attractive as Treasury rates climb. There is an emerging risk here that I believe is being under-discussed: the reserve depletion trap. By firing the 40 million barrel bazooka now, the West has used its primary leverage. If the blockade isn't resolved within 90 days, we will have used our buffer, leaving the global economy completely exposed to a second, more violent supply shock with no safety net left. One open question investors are debating right now is whether this move by the IEA reflects a position of strength or a last-ditch effort to mask a deepening lack of diplomatic options. I'd be interested to hear how you are interpreting this. Is the market right to be skeptical of these reserve releases? Let me know your thoughts in the comments. The broader message today is that we've entered a medium-term regime shift. The market has effectively deleted the disinflation narrative. Even with today's matching CPI data, investors are now pricing in a much more aggressive path for the Fed in the second quarter. We are no longer trading on where inflation was, but where the energy shock says it is going. The next 48 hours will test whether this high-conviction tech can really stay decoupled from the macro pain. We'll be watching Adobe's earnings tomorrow to see if they can follow Oracle's lead in proving that AI monetization is real. But the bigger test is Friday's PCE data. If that report confirms that inflation was already accelerating before the oil spike, it will force a hawkish repricing of the entire March Fed meeting. The broader takeaway from today's market reaction is that paper barrels aren't enough to stop our physical reality as yields climb alongside oil. The market is aggressively separating the structural winners from those who are simply trapped by rising input costs. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.